Welcome to our 2017 webinar series. This year's theme is Creative Solutions, our concepts, your clients. Each month we'll focus on stories of your clients spanning through various generations. We'll explore plans from your professionals starting on their career, newlyweds and growing families, small business owners, and soon-to-be retirees. We'll show you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month we'll focus on how to protect the business using effective tools. Each month's series will last about 50 minutes, and you must be logged in for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2017, loyal fans will receive 9 CFP CE credits, 1 for each month. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA and has been writing the LLIS story as president and CEO since 2013. And now, Mark Maurer.
Thank you, Claudia, and happy spring to many of you, and I know some of you had snow earlier this week. So there's a lot of things going on, but it's time to talk about how to protect a business. And today we're going to go over a couple things, and we're going to look at the idea of how do we protect our families and our businesses. A lot of you on the call are business owners. You're a small business owner, maybe a large business owner. If you're not a business owner, you probably work with business owners. And we have a business, we build a business, we work for a business, but that business does a lot of things. And not only does it give us a place to go to, or your clients a place to go to from 9 to 5, to keep us out of trouble, but it does a lot of other things. It provides for our families. It provides for our employees' families. So when we talk about protecting a business, it's not necessarily just that the doors will stay open and the rent gets paid. It's that there's all those subsets of people who are depending on that business to stay going. And so first, we're going to talk about a buy-sell agreement. What happens in the event of a business where there needs to be a transition because somebody's passed away, an owner's passed away, or an owner becomes disabled? How do we look at that? How do we set that up? I'm going to talk a little bit about estate equalization. And I think for a lot of you, and it's common for me to get these sort of requests as advisors come to me to say, here's sort of my client situation. Have a fairly nice net worth. A lot of it is tied in the family business, or not even a family business, just the business. There's 1, 2 children who are active in the business and who mom, dad want to take over the business and pass to, but there's not everybody works in the business. And so how do we look at transferring what may be a very large asset to some children and equalize for others? And then we're going to talk about long-term care insurance. And now I'm not going to talk about provisions of policies necessarily, but there are some neat tax benefits for business owners, and so I'm going to touch on those a little bit, and then I'm going to give you an idea that might be neat for you or some of your clients. So let's talk about a buy-sell. What is a buy-sell? I think a lot of times advisors, clients think as long as I have a life insurance policy in place, then we've got a buy-sell. We don't. We have a life insurance policy. A buy-sell is a written agreement, should be written by an attorney, that defines who's going to buy and who's going to sell if an owner passes away or becomes disabled, and at what price. So when you have multiple parties and they come together with this agreement, everybody sort of has to agree, because you have to agree on a price, you have to agree how it works. So it's the mechanism for how you transfer shares or percentages of a business. In this case, insurance is just the funding. So life insurance, if somebody dies, life insurance funds the buy-sell agreement because it says owner A has to buy out owner B's shares. Well, if that's a $3 million business, owner A needs to come up with $1.5 million to buy out owner B's estate. Well, how are you going to do that? Other options available aren't great, like buying out spouse of B through future earnings. It may take a long time to buy out $1.5 million, pay out $1.5 million, especially if that owner now is gone and we don't have his or her revenue anymore. How about borrowing? Probably the time to go to a bank and say, hey, can I borrow $1.5 million because my partner just died? Probably could be the worst time to ever go ask for a loan. We're not showing stability. We're sort of in a crisis at this point. Liquidation. We have to sell the business or sell parts of the business or bring in other partners, things that we don't really want to do. So life insurance is a simple way to fund the buy-sell agreement. Sorry, my clicker isn't working here. So let's take a business. It's a restaurant. It's a very nice restaurant. It's in Washington, D.C. It looks great. And we have two people, Rose and Michael, who are the owners. They've built this business. It's going well. Their fee-only financial advisor came to me and said, Mark, here are my clients, Rose and Michael. They have a restaurant. We need to look at some succession planning. So if something happened to one of them, that the other could have that. We're working on a buy-sell agreement. That's almost done. But we want to look at the funding because, most people don't have the ability to just write hundreds of thousands of dollars in one check. So Michael is 41, Rose is 37. They own this restaurant 50-50, which makes it very easy for me for the numbers. And the value of the business they determined is $1.1 million. So they each own half of that business. What happens how does the business continue if something happens to Michael or Rose? So at death, what happens? There's that $1.1 million business. It's split in half. So there's $550,000 that Michael or Rose needs to come up with to buy out the other's share. We use life insurance to fund that agreement. And they're young. Michael's 41, Rose is 37. They're in good health. They're a preferred rate class. So $550,000 of term on each of them, very inexpensive. Even if we want to go out 20 years, $612 per year for Michael, $376 for Rose. Now, what's important to remember is that life insurance for Michael, it's the same amount. They're both 20-year term lengths. Why is there such a difference? Well, Michael's a little bit older, and the older you are, the higher the premium is, all things being equal. Michael is male, and all things being equal, males pay more than females for life insurance. He's got a bigger hat, puffier hat. He's taller. Neither of those things really have anything to do with the premiums. It's the male and the being older. But that's the sort of premiums we have. In the scheme of a business generating worth of $1.1 million, this is very small premiums each year to cover that event of what happens if one of them dies, to be able to buy out the other. Disability is a different thing that I think a lot of times we don't think about. The life insurance we can visualize. If I'm dead, we can think of being dead. getting hit by a bus, accidents. Most people can visualize that. When we think of disability, we talk about not being able to work. And I think especially business owners who are running a business have a harder time thinking about that because they can't imagine something that's going to keep them from working. So it's a harder conversation sometimes because I don't think they think of it as a reality. But it's much more likely to become disabled while you're working in your younger years than you are to die. So it's definitely something that needs to be addressed. So within their buy-sell agreement, there's a provision that says if Michael or Rose can't work for up to 1 year or after 1 year, then it triggers the buyout. So why do we do that? You don't want to trigger a buyout if somebody's out for a month and a half because they broke their leg skiing. I've never worked in a restaurant. I can only imagine it's pretty tricky because you're walking around, you're talking to people, you're shuffling food here and there. So little things like, if I had a broken leg, I could still sit at my chair most of the time. If I was trying to run a restaurant and I had a broken leg, don't know if I could get in between tables. So you want a longer elimination period because you don't want anything short that would have those normal sorts of things prevent somebody from, that are going to be out for a little bit, come back, so use a longer elimination period, like 1 year. And again, if after a period of time Michael or Rose can't work after a year, then it triggers the disability portion of the buyout. And so we use disability buyout insurance to be the funding mechanism. The buyout is what triggers both of it. Life insurance and disability buyout fund are the funding vehicles. So we look at a DI buyout policy for each of them. Benefits, they can keep this policy to age 65, so the premiums are level to age 65, and it has a 1 year elimination period. It works out really well. The buyout is after 1 year. This is a 1 year elimination period. And we looked at a $550,000 lump sum payment. The life insurance has a $550,000 lump sum right away. You don't recover from death. It's pretty final. Disability, you have that 1 year, and then we designed it for a lump sum option so that each of them would be able to buy out the other's shares after that 12 months. The annual premiums, though, for Michael are almost $2,900 a year, and Rose, $3,400 a year. Remember, Michael's insurance was more because he had the puffy hat? Well, Rose's insurance is more because women pay more for disability insurance than men. Men pay more for life insurance. Women pay more for disability insurance based on claims experience. But also based on claims experience, the premiums are much higher because it reflects that they are much more likely to become disabled between the period of time of now and age 65 than they are to die even in the next 20 years. If you had the same likelihood of death and disability, then this premium should be basically, this and the 20-year term premium should be basically the same. But they're much more likely to become disabled, and so the premiums for the disability buyout reflect that. And so the advisor came to us and said, the term is sort of that's sort of a no-brainer. It's not very large premiums in the scheme of things. The disability buyout, I understand, it's more likely, it's similar benefits, but is there a way to reduce the DI premiums a bit? And the answer is yes, we can. So we looked at the buyout, which says that after 1 year, there needs to be $550,000 in total payments. And Michael and Rose said, well, when it's disability and we're still alive, it's okay. We don't need that as a lump sum. If we can save some premium dollars, then we could stretch out those payments. So we looked at that. Annual premium for Rose, $34.21 for a $550,000 lump sum after a 1 year elimination period. We can stretch out that $550,000 in payments over 1 year or even up to 5 years. So they're still getting the total amount of payments. There's not an inflation or COLA, it's just a flat number. So by stretching out, instead of $550,000 after 1 year, if we stretch out the $550,000 over 5 years after the 1 year elimination period, the annual premiums are about 12% less. So that was one option that we looked at for them, and sort of helped with the idea of this trying to reduce the premiums but still get us to the same place. I have a question. How do you handle the fact that business valuations typically increase over the term of the insurance? That's a good question. When looking at valuation and amounts for life insurance, disability insurance, insurance companies will normally allow us to use some sort of factor of increase. It's usually based on some amount of growth that they can verify in the past, and usually only for maybe the next 5 or 7 years. So we can't, insurance companies won't necessarily allow, okay, it's been growing at 10% every year for the last 5 years, or last 2 years, let's say, we're going to assume that kind of growth over the next 25 years. Not going to happen. But we can probably look at some sort of valuation that says they've had steady growth of 10% the last 3 or 4 years. If we factor that in sort of growth over the next another 5 years, then the business, let's say that's the restaurant, today worth $1.1 million, we expect it to be $1.5 million over the next, in the future. Harder with something like a restaurant, because unless they have plans to expand, add more people, it's probably more fixed. But something like a financial planning firm, where you can add people as you get more clients, it probably has a better likelihood of saying, here's how it's grown in the past, here's what we're doing, and if we factor that out 5, 7 years, then we can use a higher number than today. Good question. So like I mentioned, you have the business, but you're protecting still lots of different things. We're protecting the business. We're protecting, in this case, a place where people can come eat. It's where they meet. It's like Cheers, where everybody knows your name. Everybody loves it. That's where they come. So it's helping that be there for their clients. It's helping it be there for their vendors, the people who buy the food, the people who they buy food from. So there's the vendor relationships, the client relationships that are attached to the business. You have the employees. The employees work there. They need their paychecks. So it's protecting those employees and the fact that they need a place, they have a place to come and work. And of course, it's protecting the family, our 2 little chefs. If something were to happen to mom or dad, then that's what we're protecting too, that the value of the business can be bought out by Michael or Rose, can buy it out and then give that money to the estate, to each other, to transfer that business. So there we have a restaurant. Split evenly 50-50. For the math, it all worked pretty well. So I want to get a little more complicated, but also something that probably hits a little closer to home. Regularly, advisors call us because they're in the midst of this sort of planning process. They're looking at buyout insurance. They're looking at succession planning. And how does it work depends on every firm. Not every firm's the same, of course, but you have nuances where some advisory firms are much like Michael and Rose. It's owned 50-50, similar age, you do the same things. It's not all that, not all that different. What works for one is pretty much working for the other, and then we have small differences in premiums based on age or health. ABC Financial Planning is another good example, because this probably is the other half of buy-sell succession planning situations that I see. So we have Gary. He's over there on the right. But Gary is the older of the three. Currently owns a little bit over half of the business. And you know what he wants? He wants out. He's ready to retire. And he's got great people. He's got Larry and Sherry who work with him. They're already part owners, and they've got the buy-sell in place. They are working on the planning, the succession, the how do we get those 5 and 10 years. They're working on getting Gary's ownership down to zero through buying, Larry and Sherry are buying Gary out. So that in the next 5 to 10 years, the plan is Gary has no ownership. He's retired. He's sitting on a beach in the Bahamas. Larry, who's already the larger owner, is going to be the larger owner, Sherry. Similar. So a lot of times this is more similar to situations that we see. Sometimes everybody's the same age. More often than not, there's somebody who's the primary owner, ready to get out, and we have either younger people or smaller owners who are going to buy out that majority owner over the next, and 5 to 10 years is pretty common too. So we're going to set up a buy-sell, and we're going to look at 2 different types of buy-sell agreements. So there's an entity purchase and a stock redemption. Or stock redemption, which is also an entity purchase, or a cross-purchase plan. So stock redemption, entity purchase is one type of buy-sell arrangement. In this arrangement, the corporation owns the life insurance policy, and the corporation, the business, is the beneficiary. At death of one of the owners, the corporation buys the stock from the deceased owner's estate and redeems it. It retires those shares. So the 2 surviving owners, their ownership percentage increases, but it increases proportionally. Their basis is unchanged. So if Sherry and Gary each own 10%, for the sake of argument for nice round numbers, Larry and Sherry each own 10%, Gary owned 80%. In a stock redemption plan, Gary dies, then the company retires his shares. Larry and Sherry, all of a sudden their shares their percentage balloons. They don't own 10% anymore. They each own 50%. They actually have the same number of shares, so their basis is unchanged. Their ownership percentage increases. It would increase proportionally if they're not even, but it retires those shares. So the basis sometimes is the big issue with stock redemption or entity purchase. But good things is it's all corporate money. There's no employee tax on these premium payments. And from an administrative standpoint, this is what's important. There's 1 policy per owner. 1 policy per owner in entity purchase, stock redemption. Keep that in mind. Let's look at cross purchase. It's a different type. In this one, the owners own life insurance policies on each other individually. And they pay their premiums with their own money. Now, the business may bonus it to them. They pay tax on that bonus, but they own the policies themselves. When partner A dies, partner B gets the life insurance proceeds income tax-free. Because the way it's set up, now when B buys out A, I forget who died, B buys out A, then B's cost basis in that share increases to the full purchase price. So B now has cost basis on 50% ownership of whatever it was, what they put into the company, and the other 50% they just bought has a full step up in cost basis. So when it comes time to sell the business to somebody, that can be really helpful. And if we have 2 owners, we have 2 policies. A owns one on B, B owns one on A. So For Michael and Rose, that's what they're doing for their buyout plans. It's just a cross purchase. They own it on each other. Now for cross purchase, if we have 3 owners, then we need 6 policies. You can probably imagine where I'm going with this, but Sherry needs to own one on Gary and on Larry, etc., etc. If we go to 6 owners, anybody know how many policies we need? That's right, 30 policies, because each owner needs to own one on the 5 other owners. So that's 6 owners times 5, 30 policies. So cross-purchase gets really messy when we have, in my humble opinion, more than 2 owners. 3, it can be okay, and we're going to explain why it works for them, for this group. But once you get more than at least 3 partners, 3 owners, cross-purchase becomes this sort of tangled web. But for Larry, Gary, and Sherry, we ended up with only 4 policies. You say, Mark, you just told me we need 6 policies. How do we need 4? Well, here's why. Gary, up there at top, he doesn't want a policy on Sherry or Larry. Gary said, you know what, if something happens to me, or if something happens to one of the other partners, I don't want to buy their shares. I don't want to increase my percentage of the ownership. I'm trying to decrease it. I'm trying to retire and transfer it to them. So you know what? I don't need a policy on each other, because if something happens to Sherry or Larry, I'm not going to buy their shares. So they've designed it where if Gary up there at the top dies, Sherry and Larry each own a policy to buy out his remaining shares. And then Sherry and Larry own a policy on each other to buy out each other's shares. Make sense? So if Sherry were to die, Gary isn't buying a proportion of her shares and Larry's buying a proportion of her shares. Larry's just buying all of her shares. So it works well for them. Gary says, I don't want more shares. Younger people, they do. They want more shares. That's why we're doing this. Gary says, I don't want it. So that's what we designed. So there's $375,000 of 10-year term on Gary, 2 policies. One is owned by Larry, one is owned by Sherry. So if Gary dies, there's $750,000 of life insurance that they will both use to buy out half of Gary's shares. Whew. Next time I thought it was good to make them rhyming. I think I might not next time. Sherry is going to own a $1 million 15-year term policy on Larry. Now, part of that is buy-sell coverage, and we've also built in some key man. If something happens, remember, Gary wants to leave, and Larry just passed away, so Sherry's now owning a lot of shares. She's basically running the ship. So she's going to have some extra life insurance there to hire somebody, recruit somebody, promote somebody. And for Larry and Sherry, we did build in, to the question before, we did build in a little bit of assumption that they're there for the long haul. It's not just 10 years, but 15 years and 20 years, so that they will be there longer. Their percentage of shares should grow, so their amount of coverage is more than really just than what their percentage is worth today. So I hope that helps a little bit, in that I'm sure somebody listening is saying, oh, that's basically our situation. That's a really neat way to think about that, because we have an agreement. We haven't maybe necessarily done anything with the insurance part yet or the funding, but that sort of structure might work really well for our group. Looked at buy-sell planning, life insurance, disability insurance. Let's go now sort of to a bigger picture, estate equalization. So we have this family, and we have Jake, and we have Jason. Mom and Dad want to make sure that Jake and Jason are taken care of. They're parents. I think we all want to make sure that our kids are taken care of. And most parents think of their children still remaining close, even after they are no longer around. But for owners of a family business, there can a lot of times be tension after the parents pass if the children feel that they weren't treated equitably. And I have a advisor with a family that we worked with. Mom owns a business, very successful business. Son and daughter are in the business, sort of. Daughter runs the business. The son sort of comes in and out and wants to know when he can get some money. Unfortunately, they own the business. They all own equal shares. So bad that they schedule stockholders meetings and mom has to do it twice because brother and sister can't be in the room together. So how's that going to work when mom's no longer there to play referee? So maybe having set up at some point that son wasn't really going to get any business but was going to get something else might have created a more family harmony. So when they're gone, what happens? Let's say they have a vineyard, a farm. I use a vineyard because it's something that doesn't split evenly. Family business doesn't split evenly. Do you give Jake the left half and you give Jason the right half? No. It's something really large that you want somebody to retain, run, and it makes up a large part of your net worth. So Jake, mom and dad decide they're going to leave money. Money is the great equalizer. I'm sure something else has been that in the point in the past. I think there was a TV show about the equalizer, but at least today, for my planning purposes, money is the great equalizer. It's cash. So mom and dad decide we're going to treat them evenly, but equitably, but not necessarily evenly. So Jake is going to get life insurance. Jason is going to get the vineyard. So that's what they've decided to do. Mom and dad are John and Jane. John's 60, Jane 58. He's standard, she's preferred. So what they decided to do is look at annual gifting. John and Jane are already using gifting and buyouts to transfer ownership to Jason of the vineyard. So they've already got that step in, that's already rolling, that's already going. So they're using their annual gifts to him to transfer shares of the business. For Jake, they're going to decide to use annual gifts, the annual gift exemption of John and Jane, $14,000 times one Jake, of $28,000. They don't want to just give Jake the money now. They could. Instead, they want to use the life insurance to transfer assets at their death. And we looked at options for them for paying the premiums for 20 years. John will be 80, Jane will be 78 when that's done, and that's done. It's all set up. Or paying the $28,000 per year to age 100, as long as they're around, to maximize those annual gifts every year. We use a no-lapse guarantee SUL, or Survivorship Universal Life Policy. It's a lot of words right there, but no-lapse guarantee means that as long as it's almost like a lifetime term policy covering two people. As long as the premiums are paid on time, the life insurance is guaranteed for as long as they live. And that premium for 20 years guarantees a little over $2 million of life insurance to Jake. If they want to pay on it to age 100, as long as they're around, it gets to about $2.7 million. That's what passes on to Jake when the second one of them passes away. That's the equalizer, is a giant check. Well, not really a giant check like the Publishers Clearinghouse. I don't think you can actually cash those, but a check with a lot of zeros behind it. So who should own the policy? We have a couple options. One, Jake can own the policy. I'm going to say mom and dad shouldn't own the policy because at death, that $2 million or $2.7 million gets added to their taxable estate. They already own a vineyard. I don't think they're hurting. So they may already be in a taxable situation. So if mom and dad own that policy themselves, that's just taking their taxable estate from 10 million to 12 million or 10 million to 12.7 million. We don't want to do that. So to maximize those, to use the annual gifts, got to give it away. Who am I going to give it away to? Well, Jake can own the policy. Okay, Jake's the owner and the beneficiary. It's separate from mom and dad, check. So they're going to give Jake $28,000 a year. It's under the annual gift exemption. Jake's going to use those, take that $28,000, write the premium to the life insurance policy. Or they can set up an ILIT, irrevocable life insurance trust. ILIT is a separate entity. It has its own tax ID number. There's a trustee. Every year you have to do crummy letters that turn the gifts from a future value gift to a present value gift. There's some administrative stuff you have to do. It gets its own tax ID number, and the attorney or CPA files for that. But it's also a separate entity. So it's also kept out of their life insurance. It's kept out of their taxable estate. A benefit to having an ILIT is that there's a trustee. Jake may be really bad with money. So having that trustee there, can be a professional trustee, somebody else, can be a way to control Jake's ability to take money out of the trust. I would not have Jason do it. Can't imagine a better way to ruin a brotherly friendship than to say, hey, Jason, you're responsible. You get to dole out money to your brother. Whew. Would not want to be on that, in that room when somebody's reading that. But if Jake's responsible, he can own the policy. He'll get the $2 million or $2.7 million. It just depends on the kid. Who do we need to worry about, him or her? And the nice thing about the trust is it protects from creditors, predators, and divorce. If Jake owns a policy, one day he gets $2.7 million, that's his asset. It can be split. It can be taken to Vegas. It can do lots of things that maybe mom and dad didn't intend for it to do. I have one question come through. How do you work with advisors to introduce some of these themes to clients, ever get on a call with all stakeholders? And I think this was probably from a couple minutes ago, talking more about some of the buy-sell. Absolutely. I think for both of the scenarios I used are actual clients. One's an actual planning firm we're working with. One's actual restaurant owners. I was on conference calls with all of them. Because it requires everybody to be on board. Everybody has to understand, yes, I'm applying for life insurance. Yes, my partner is going to own a policy on my life. And so I need to make sure that I don't think my partner is going to try to cut my brakes, a couple weeks from now so they can get my, the life insurance. I joke. But, so yes, regularly I'm on a conference call talking to the advisor and the shareholders, the business owners, to talk about sort of what we're doing and what it accomplishes. So thank you very much. All right, the last thing we're going to talk about today is long-term care insurance. It's 1 week before everybody's taxes are due. It's too late to do anything for this year if you see something you really like here. However, it's not too late to do something for next year. So in spirit of tax day, we're going to talk about tax benefits for business owners when it comes to long-term care insurance. I'm not going to talk about the state, any individual state income tax deductions. I'm here in Florida, yay, no state income tax. But I have charts. I have lots of information about these. If you don't have them, I'm happy to share. So I'm not going to talk about each state. I'm going to talk about the federal level and what deductions are available for your business owners and for any of you who are business owners, which I'm looking at some of the names of people on here. I know this is a lot of you. Let's talk about just plain old individual. What can we do? I think one thing that we could do to really reduce the drag on Medicaid, Medicare, just the health programs that we have here in this country, if we could fix this part. Because long-term care premiums for individuals are deductible as a medical expense only if it exceeds 10% of your AGI. And the only amount I get to count towards that is the age-based eligible table limits. I'm going to show you what those are in a second. But basically it says that it doesn't matter what I actually pay, you get to use some amount. It's a specified amount. And if that plus all of your other medical expenses are less than 10% of your AGI, you can't use any of it. And if it's 11% of my AGI, I only get to deduct 1%. Is it any surprise that this isn't necessarily exciting to the average person? It's just not that great. How many people probably would start looking at policies, or how many of your clients could we probably talk into it and say, I know you've been, this is something we need to talk about. The laws just changed and now we can deduct 100% of your premiums. I like deductions. I think that would be exciting. I think getting more and more people long-term care coverage could help with a lot of the Medicaid and a lot of issues out there, and would help get probably a wider group of people insured. I'm done off my soapbox, but write your congressman. Here's the IRS age-based table. So if you're between 41 and 50, regardless of what your long-term care premium is, you only get to consider $770 of it. So I have all my other medical expenses and I get to add $770. If those numbers don't exceed 10% of my AGI, can't deduct anything. If my medical expenses plus my $770 get to 11%, I get to deduct 1%. Not exciting. Until you're over 60. Doesn't really seem fair here, does it? It's 400, 700, 1,500, 4,000. It's not quite a very nice level slope there. But it is what it is. The IRS giveth, the IRS taketh away. So if you're a business owner, and we're going to say that you're a sole proprietor, your client's a sole proprietor, they can deduct 100% of out-of-pocket premium up to the age-based eligible premium per the IRS table. And it's not necessary to meet the AGI threshold. So already that's good. That's better. My premiums, whatever it is, I can deduct. I get $770 I get to deduct. I'm not sure. I guess at some point the IRS is worried that people are buying really big long-term care policies and that they might use it to pay for care. Yeah, you don't get in a check. It's reimbursed. Most plans are reimbursed for expenses. So it's not like I, plan to hurt myself worse to use more long-term care benefits. Haven't quite figured this out yet. But when you're a business owner, it's nice because you don't have to meet the AGI threshold. If you're 42, you get to deduct $770. And the deductible amount includes eligible premiums paid for spouse or dependents. So if I'm a sole proprietor, I'm 42, I can deduct $770 for myself and $770 on my wife's policy. Okay? So better. Far better than being an individual. It's better than a stick in the eye. How about partnerships, LLCs, subchapter S corps? The organization pays the premium, but the owner must include the LTC premiums paid, person, owner, whoever, must include the LTCI premiums paid for his or her benefit in their AGI. Then we're back to the same thing. May deduct 100% of the age-based eligible premium amount, not necessary to meet the AGI threshold. Pretty good. Again, $42, $770, no AGI threshold. I had to pay tax on it, but hey, again, it's better than being an individual. Now let's talk about exciting. As exciting as taxes on long-term care policies can be, but it's exciting. I have a very dull life, so this is exciting. C Corporation. The business pays the premiums for any employees, spouses, or dependents, and the business can take a 100% deduction on the total premiums paid. So not just the employee, but spouses, dependents, and the business gets to deduct 100% of the premiums paid. No $770. Premium is $2,000, it gets to deduct $2,000. Not limited to that age-based table, not limited to $770 for a 42-year-old. The employer can be selective in the classifications of employees it covers. You can have 70 people and you can say, I just want to cover the owners, who happens to be you. So there's no, like some of the other plans, employee benefits where you have to cover classes. You can pick and choose. There's nothing that says any limits on who you can and can't cover. For the employee, which would be an owner, anybody, the entire LTCI premium paid by the business is excluded from their AGI, even if the premium exceeds the eligible premium in the IRS table. Premium's $2,000. Business gets to deduct it. That $2,000 never shows up. I don't pay tax on that $2,000 as an employee, or $3,000, or $500, whatever it is. I don't pay tax on it. The employee doesn't pay tax on it. So it's a win for the employer. It's a win for the employee. And when I go on claim, or anybody goes on claim, you don't owe tax on the benefits. Like with employer-paid disability coverage, you get to deduct it. I don't pay tax on it. But when I use my group disability coverage, then the IRS says, well, that's taxable. Not true with long-term care. Business deducts it. I don't pay tax on it. When I go on claim, the benefits are tax-free because it's a long-term care policy. So it's great for the business, great for the employee while they're working, while the employer's paying for it. And when the employee goes on claim, there's no penalty, so to speak, like with group disability where, oh, those benefits are taxed because nobody paid tax on it in the first place. For a C corporation, it's a win-win-win. Another thing that probably could be done is to have other businesses get this sort of favorable treatment. Again, they're providing something that somebody may use if they can't perform 2 of 6 activities of daily living or have a cognitive impairment. You can't just take money out of this policy. So it's really a neat thing that if we could get more businesses to be able to offer this, we would probably have more people who are covered. Less drain on other programs. We used to have long-term care policies that were paid up at age 65. Why do I say I miss this? I miss my Ford Bronco. I loved that. It was the greatest vehicle ever. But if any of you ever had one and have tried to get a baby seat in the back, you open just one of the 2 doors, try to get the baby seat in the back, you flip seats down. It's not practical, especially when baby 2 came along. But I miss that Bronco every day. Ooh, ouch. Horrible taste. I love the Bronco. Ouch. But so long-term care policies, we used to have that option that it was almost like a golden handcuffs. So you could say we're going to pay on this premium for you, Mr. Employee, Mrs. Employee. And at age 65, you retire and we're done with that. Business deducted them. Employee never received it. And age 65, it was done. So I miss those. But we don't have that yet. When interest rates start to come up a little bit higher, I think, and they stay higher, I think we might see some of those come back. But today, we don't have that as an option. So I wanted to give you the next best. I'm going a couple questions here. One or two of these I probably need to check with you and get some more information on it. One question is, for the LTC insurance premiums that are paid by a business, does that LTC policy have to be in the name of the business? No, it's in the name of the person. I don't even think a business can own a long-term care policy. So it's still the person. The premiums are just made directly to Mutual of Omaha for the business. Okay, so Mutual of Omaha, what they have on one of their long-term care policies is called a buy-down option. So let me show you how that works. I use Mark and Leah. Why? Well, I know both of our birthdays, so it's easy to run quotes. And LLIS is a C Corp. So rather than trying to imagine somebody, I use two people I know fairly well and a C corporation. So I looked at, what if we were to get a long-term care insurance policy today? I used $5,000 a month based on cost of care here in Tampa. It doesn't cover everything that we might need if we needed care, but covers the majority of assisted living facility, adult daycare, home care, and about 80% of what the skilled care costs are. I used 3 years of benefits each. It's about the average that people use. Some people use less, some people use more, but so I added the shared care rider that creates this pool of 3 years of benefits that we each can share. Pool of 6 years. So if I used 3 years of care, I could start dipping into Leah's 3 years of benefits. And I used a 4% compound inflation because I'm going to have the business pay those premiums. And so I'm going to use an inflation option that grows this long-term care policy. For this particular policy, the premiums are $6,900 a year for the next 23 years until I retire. And I made these slides. I should have had myself retiring earlier. But I'm going to be here for 23 years, apparently. So we're having the business pay the premiums. It's deductible. I don't recognize any income on it. So basically using all of those benefits to purchase this policy. And the $5,000 a month is going to grow at 4% each year for the next 23 years. So in 23 years, that $5,000 a month has grown to $12,000 a month. Pretty great. And then what I do when I'm ready to retire is I exercise the buy down. So I get to keep, the buy down says you're going to basically change the inflation option at that point in time. So I had the 4% growth for 23 years, 12,000 to 12,320. But at 23 years, I'm going to retire. I don't want to have the benefits keep growing, and I don't want to pay as much premium. So I'm going to reduce the policy inflation to 1%. So instead of 5 to 4% growing pretty fast, I got it to grow pretty far for 23 years. And now it's at 12,000, so I'm going to take it to a much smaller inflation option. What's neat is at that time the premiums are based on my issue age 23 years ago. So had I purchased the same premium, it's based on my younger age. So you may think, well, you're trading it in 23 years, it's a much bigger policy, it costs a lot more. No, it's based on my younger age. So 23, 24 going forward. So what did we do? We used the business to pay the premiums and get that growth for 23 years. Then when I retire and take it over myself, I bring down the inflation option. Still grows a little bit, but I had it grow faster than I needed to for 23 years, and then I start to level it out. And then when I take it over, I get to keep the growth, Still have a little bit of that inflation going forward, but the premiums are now $2,300 a year. Remember what they were? $6,900 when the business was paying for it. So my out-of-pocket is half of what it was for 23 years. Paid higher, used the business, all the favored tax benefits of it, and then when it came time to give it to me, for me to transfer it out, I reduce the inflation option, and it cuts my premium almost in half. So by more than half. So not quite totally paid up at 65, but a way to use company money, the business money, to provide a benefit to me, to another owner, to a top person, and then when they leave, retire, they have the ability to take that policy at a much reduced option, grew fast while they were working, reduce it later, and have a much smaller premium going forward. So what did we do? The whole point of a lot of this is to protect our families. We say we're protecting a business, but really a business is a means to an end to provide business owners with an income, to provide employees with an income, who then take care of their families with that income. So protecting the business keeps a lot of things going. So we use life insurance and disability insurance to cover buy-sell agreements. When we need to transition the business between children, maybe some who don't work in the business, some who do, we can look at life insurance to equalize an estate. Tax benefits for business owners. Pretty neat idea. Anybody has any questions, please feel free to give me a call. It's a neat way, if you have a C corporation, to use the business. So what's coming up? Later this month, we're doing a Genesis member webinar. In May, we're doing a XYPN member webinar, and Jerry and I will be in Bellevue, Washington for the NAPFA Spring Conference. Then later in the summer, we will be at the Garrett Retreat, the XYPN Conference, and then in the fall, the NAPFA Conference, about an hour and a half away over in Orlando, and the ACP Conference in San Antonio. So for any of you who aren't familiar with us, what we do for fee-only advisors, we provide a lot of benefits that are designed around fee-only advisors. One of those, as Claudia mentioned at the very beginning, are free monthly webinars. We have another one in May, and we have 6 more throughout the course of the year, 1 hour CFP, CE approved. We're not your competition as a fee-only advisor. We do insurance, you don't. So we work together. A lot of times I like to think of the fee-only advisor as a general contractor, and we're a subcontractor. Subcontract out insurance implementation for your clients. Our only clients are fee-only advisors, and we work really hard to save you time and your clients money. One of the ways we do that is to pre-underwrite insurance policies to avoid surprises. We have a lot of tools about long-term care. How do you talk to your clients about long-term care? What is Pension Max on our website? We're proud sponsors of a number of different fee-only financial planning groups. We have specialists in different types of insurance, life insurance, disability insurance, long-term care annuities, and hybrid long-term care policies. And we're here for the long haul. Like I said, I just told everybody that I'm going to be working here another 23 years. So we designed systems to help prevent your clients' policies from accidentally lapsing with our advanced premium emails, or when clients are coming to the end of their term policy, whether it's continue the policy, convert it, or maybe it did exactly what it was supposed to do. We have our notes, or a notice of term expiration. And coming soon, we are going to have the official launch of LLIS. LLIS is our website that we designed with advisor input to help manage your clients through the insurance application process even more smoothly than we do now. and to give you access to information about your clients, their policies, and so to give you instant access and the ability to check status anytime, 24/7. And I have a few questions that came through that I need to do a little more research. They're good questions, which if I have to look them up, you know, you asked a pretty good one. So I have two of those that I need to look at. Does anybody else have any other questions? If you haven't, type them in. Yes, I can show that. Question was, can you go back about the new website? Yes, I can't wait for it. For anybody who's designed a website or done anything like that, I can only imagine it's like trying to build a house. You think you're done, and then you think you're done, and you think you got it, and say, oh, just one more thing. And so I'm very excited about it. All right, I don't see any other questions. I have two that I need to respond to, and I will look those up. But again, thank you everybody, and I hope your rest of your tax week is uneventful, and look forward to hopefully seeing everybody at some point at a conference throughout the course of the year. Thanks. Bye.